If you've been following the 60-40 rule, 60% stocks, 40% bonds, you weren't doing anything wrong. That strategy was the right call for a long time. Smart people built real retirement security with it. But here's what actually matters right now. The conditions that made 60-40 work so well have shifted. And if you're in your 50s or early 60s, this is worth understanding, not because you need to panic, but because a few thoughtful adjustments could make a real difference in how your retirement holds up. Let me break it down.
The 60-40 portfolio has roots going back to the 1950s. The idea was straightforward. Put 60% in stocks for long-term growth and hold 40% in bonds as a cushion. When markets dropped, you'd sell your bonds, which typically held their value, instead of being forced to sell beaten-up stocks at the worst possible moment. That second part is the key. It's what financial planners call sequence of returns risk. Think of it this way. If a major market drop hits in your first year of retirement and you have no safe assets to draw from, you're forced to sell at a loss. You lock in the damage before the recovery ever comes around. Bonds were specifically designed to prevent that scenario, and for about 4 decades, they did exactly that. From the early 1980s through the 2010s, interest rates were in a long, steady decline. When rates fall, bond prices rise. So bonds weren't just stable, they were quietly appreciating. The 60-40 portfolio was almost perfectly suited to that era. Here's the honest reality. That era is over.
In 2022, something happened that most investors had never seen before in their lifetimes. Stocks and bonds dropped at the same time, and dropped hard. The stock market fell roughly 19%. What stunned a lot of people was that long-term bonds fell even further, closer to 30%. The asset class that was supposed to cushion the blow made things worse. The culprit was inflation. When inflation runs hot, the Fed raises interest rates. When rates rise, existing bond prices fall. A bond paying 2% suddenly looks a lot less attractive when new bonds are paying 5%, so the value of what you're holding drops. Most people don't realize that the 40-year tailwind that made bonds so reliable, steadily falling rates, is simply not there anymore. We're in a different environment now. Higher government debt, inflation that hasn't fully gone away, and interest rates that aren't heading back to zero anytime soon. Real talk. This doesn't mean bonds have no place in your portfolio. It means expecting them to behave the way they did in 2005 or 2012 is probably not a safe assumption anymore.
Before we talk about what to put in your portfolio, let's talk about the single most practical thing you can do to protect yourself from sequence of returns risk in this environment. It's called a root reserve, and it's simpler than it sounds. Set aside 5 years of living expenses in stable, liquid assets. Cash, money market funds, short-term CDs. Not stocks, not long-term bonds. Money you can actually reach without selling anything. If markets drop, you live on the reserve. You give your portfolio time to recover before you're forced to touch it. The average bear market lasts about 2.5 years. 5 years of reserves means you can wait it out without locking in losses. At this stage of life, that buffer isn't a nice to have. It's the foundation that makes every other strategy work.
Now, what about the bond portion itself? What can actually do the job bonds used to do? There's no perfect single answer. I want to be honest with you about that. But here's what's worth considering. First, if you're keeping bonds, shift toward shorter durations. Bonds maturing in 1 to 3 years are far less sensitive to rising rates. You still get some income and some stability without the dramatic losses we saw in 2022 with long-term bond funds. Second, think about real assets. Gold has historically held its purchasing power when inflation runs hot. Central banks globally have been quietly increasing their gold reserves. That's not a coincidence. It's not an exciting play. It's a store of value for an environment where paper assets are under pressure. Third, energy exposure is worth a look. When inflation spikes, it's usually connected to energy costs. Energy companies often hold their value and pay meaningful dividends precisely when the rest of the market is struggling. Some analysts now call energy stocks the new bonds for this reason. Think of it this way. The job bonds used to handle on their own now takes a combination of shorter duration fixed income, real assets, and dividend-paying equities to accomplish. It's not a single replacement, it's a team.
Here's what I'd encourage you to actually do with this. First, look at your bond holdings and check the duration. If you're sitting in long-term bond funds, understand the risk you're carrying. Shorter duration is more appropriate for this environment. Second, make sure your root reserve is in place before you adjust anything else. That's the foundation. Third, ask yourself whether your portfolio has any real asset exposure at all. Gold, energy, REITs, even a modest allocation can change how your portfolio behaves when inflation is the main threat. And finally, on the equity side, quality and durability matter more than maximum upside at this stage. Dividend-paying companies that have held up through multiple market cycles tend to be more resilient than high-growth speculative names when things get rocky. The 60-40 rule was never really about the specific numbers. It was about balancing growth with protection. That idea is still right. We just need updated tools to carry it out. The good news, and there is good news, is that it's not too late to make these adjustments. The decisions you make in your 50s and early 60s can genuinely reshape how your retirement looks and feels. Not perfectly, but meaningfully. If this raised questions about your own portfolio, drop them in the comments. I read every one, and your question might just become the next video. And if you found this useful, share it with someone in your life who's thinking through the same things. Because most people navigating this stage are, even if they're not talking about it. Subscribe if you haven't. Every week, we work through this stuff together. Plain English, no shame, no noise. I'll see you in the next one.